This episode of Stock Club is brought to you by Hyundai. Restart your journey towards a greener world with Hyundai's next generation of zero-emission cars. Find out more about their range of electric vehicles and the savings they can bring to your company and employees at Hyundai.ie. Hi there, and welcome to the Stock Club podcast. I'm James, and with me this week is my Wall Street co-founder and chief investor Emmett Savage and our head analyst Rory Carron. In this episode, we're talking about some of the upcoming IPOs that we're most excited about, the perfect number of stocks to hold in your portfolio, and our favourite land and expand companies. So for our American listeners tuning in, today should be the day after Thanksgiving, which of course is better known as Black Friday. Last year it was estimated that consumers spent about $69 billion in total over the Thanksgiving weekend. That's not including the sales from Cyber Monday that comes the Monday after either. This year's obviously going to be a little bit different though, and I have to say, if there's one thing I'm really going to miss, it's all the videos of people attacking each other over flat screen TVs in malls across America. Emmett and Rory, are you guys planning to pick up anything this Black Friday?
Are those videos going to be gone?
Sorry?
Are those videos going to be gone? Why? What's happening that would stop those videos?
there is maybe you haven't heard, but there's a global pandemic at the moment, Rory, and it's probably not the best idea for people to be going to malls.
Yeah, well, let's see. I did see a report that Cyber Monday has overtaken Black Friday as the most important shopping day of the year.
But every day is Cyber Monday this year. I mean, every single day is Cyber Monday. I was a late adopter to Amazon Prime, and since I signed up for it there during the summer, there's a steady stream of things being dropped at my door, like every day, 7 days a week. And really, I think it's Cyber Monday and overdrive.
I can't remember who pointed it out, but someone said it's been a while that we hadn't known what's going to be in an Amazon package when it arrives at the house. But
it's pretty exciting.
It definitely is.
Yeah.
I just got a text there before we started recording, and I'm waiting for a delivery driver to ring me in the middle of this. So if I duck out for a minute or two, just carry the show, guys.
No one will notice, James. Don't worry about it.
Low blow. So let's move on to some more important news then. So after the madness of the US presidential election, the biggest news that's kind of come out over the last 2 weeks has been the slew of private companies that are lining up to go public. The largest of these is of course Airbnb, who filed their S1 early last week and looks set to float time sometime before the end of the year. Doordash also filed their S1, the largest meal delivery service in the US, coming hot off the heels of their Proposition 22 success in California. Although it can be really exciting for retail investors when they get the chance to invest in these companies that they might have been watching for a while, we've had an unwritten rule here at MyWallSt for a while now that we don't invest in IPOs straight away. Rory, can you explain just quickly why we have such a rule in place?
Yeah, I mean, sort of related, but not totally related, is that Charles Duhigg, who wrote a book a few years ago called The Power of Habits, which is a great read, wrote a really great piece in the New Yorker earlier this week titled How Venture Capitalists Are Deforming Capitalism, which is mostly formed around the WeWork fiasco, dumpster fire, whatever you want to call it. And I would highly recommend people read that article. It was very well written, and it kind of looked at, you'll hear all the normal stories or the old stories you've already heard about WeWork, from the smoking marijuana to the one to be president of the universe. But it kind of takes a look at it from the point of view of the VCs that back the company and the kind of lack of leadership from the board. So that's a good kind of primer for one of the reasons that we don't, go straight into a company pre-IPO is, first of all, at an IPO, someone is selling you something. This is a sale event. I think people forget that quite a lot. Especially these days, there's a huge amount of private money out there that fund companies to the size that we saw off previously with Uber going out, as expected to go out at kind of $80 billion. That sort of was unseen, 10 years ago, when a company grew to a certain size, and then private money couldn't really fund it any further. With so much private money now, where companies can kind of continuously grow using that money, it seems like almost indefinitely, you always have to ask yourself a question when a company's IPOing: why are they IPOing now? What's made them decide that this is the moment? And, an awful lot of that time, it is a question of finance. They want to grow the company bigger, and access to the public markets is going to create that. But sometimes you do see cases, and WeWork was a great example, where, the ship had come off the rails. I don't know, ships don't go on rails, but you know what I mean. The
ship shouldn't have been on the rails.
The ship shouldn't have been on the rails in the first place. What was the ship doing on rails? And that's a very good that's a very good metaphor for what was happening at WeWork and how they were trying to kind of get out of that investment and basically, you know, defraud the public markets by pushing it on to them. So that's not the reason we don't. I'm going on a tangent here. That's not the reason we don't invest in IPOs right away. What we do is we just try and wait and see, let them settle into the public markets for a couple of months. Let them find kind of, you know, the whole support and resistance that you know, traders would talk about when, and see a couple of quarters play out just before we kind of make a decision. It doesn't mean users can't, you know, everyone's entitled to go and purchase whatever they want. And there's a great, I suppose, feeling of being in on the ground floor that people want to be part of. But it's just a kind of word of caution more than anything. And it's a stance that we try and hold ourselves to.
We have broken the rule a few times, though, haven't we?
I think we broke it once with Slack.
Yeah.
I kind of justified that it was a direct listing. It probably was.
Yeah, it was a DPO justification. Yeah. But I've actually broken the rule on Horizon a few times, and even with SPACs, which are offering a huge opportunity for investors now. But like IPOs are the lifeblood of our pursuit, and they kind of keep the entire ecosystem of investments fresh. So while we generally have a guideline that we don't invest in a company soon after IPO for the reasons that Rory explained and lockup periods and all the rest, we are very appreciative that they happen because they are filling the funnel with quality businesses. We're just waiting for those to kind of bed down before we commit our capital, because a company a flotation is for life, not just for Christmas, like a puppy dog. I mean, this business that floats should be around. If it performs well, it should be around for decades to come. So rushing in at IPO feels like a little bit of reactionary, but there are times when it is in fact the right reaction.
Yeah, and it's exciting as well. It's exciting to see new businesses. You know, it's like a video game when a new playable character becomes, available. Everyone gets excited about it.
Absolutely.
Your analogies today, Rory,
I'm on a roll.
You're on a roll.
So let's dig into some of these companies that are set to go public then. Emmett, I'll come over to you first. Which of these upcoming IPOs are you kind of looking at the moment?
There are a lot of IPOs lined up for the months ahead, and in fact for 2021 already, and the big blistering one that everybody is waiting for is Airbnb, and I think Rory might touch on that in a moment. But some of the names that have crossed my desk in my research for IPOs are, and I'll just run through a few of them. I have a list of 12 that are actually very interesting to me, but I'm not going to go through them all. But one is, for example, called Roblox, which a lot of our listeners will be familiar with, or I'd be surprised if they aren't familiar with it, because it's a business that currently has 150 million monthly active users for its gaming platform, which is a game creation system focused on kids, and users have spent 1.5 billion hours per month playing Roblox games. This is a game maker, if you like, that I never even heard of before the prospectus was launched. So I think revenues are forecast to hit like $250 million this year. And when I looked at it, I looked up what did EA's FIFA, which is kind of the game that is played in my house a lot. What has it had? It had 10 million players, 450 million matches. And when you put that beside Roblox's 150 million monthly active users, it kind of puts it's a frame of reference, I guess. It is a huge one. And there aren't a lot of details. Maybe you have some details on the Roblox IPO, do you, Rory?
It's definitely, I think it's probably one of the most interesting S1s I've read in a while. And I only got a chance to quickly glance through it, but some of the numbers are outstanding. 75% of American children between the ages of 9 and 12 play Roblox regularly with friends. Like, that's according to the company.
Wow,
75% of American children ages 9 through 12 play Roblox.
What?
Yeah. And I mean, and you think like, oh, well, is there any money in that? Yes, there's loads of money in it. They brought in $1.2 billion in bookings in just the first 9 months of this year. And what's the so I knew very little about Roblox before this S1. I thought it was a game, just kind of like Minecraft, and in a way I suppose it is, but it's actually not at all. It's a kind of game engine where you can build your own games using a kind of building block system that's very similar to Minecraft. Obviously, that's where I kind of got made the connection. But yeah, so the idea is that it's very kind of low graphic. You build a character. There's, something like 18 million different type of games that have been developed by people throughout the system. It claims to be very child friendly. And they've got this kind of internal currency system, which they called Robux, which was a great idea. And similar to kind of Apple or Google, they take this 30% cut from the developer. So any money that's generated within someone's game, they get a 30% cut. But, and this is the really interesting bit, there's also an internal exchange rate within the company, which basically means that at the very least, Roblox is taking a 70% cut of all the money generated in the game. So they have incredible economics for this platform. And, you might ask yourself, well, are developers going to put up with that? It seems like they are. There is more and more developers going towards this platform all the time. And the main reason is that's where the eyeballs are. This is a company that has, like Emmett said, millions of monthly active users, really low customer acquisition costs because, kids just go on it and they get their friends to go on it. And kind of as an out-of-the-box package for developers, it's kind of got everything. It's got the gravity engines, the integrated monetization, the payment solutions, and they've got customer support and moderation for all this kind of stuff. So it's quite interesting. I'm really looking forward to digging further into it. The big questions I kind of have with it is, how safe is it for kids? That's a big thing. Parents, one bad story is going to knock this whole thing off. And how sticky is it? When kids get to a certain age, do they abandon it? Some of the reading I've found is that no, actually what happens is the younger players play the games, and then as they get older, they start developing games. So that's quite interesting.
Okay.
So,
and surely they're riding on a big tailwind from COVID as well, and the lockdowns.
Yeah, huge. It's become such a vital form of entertainment for parents with their kids. Getting as much as it might not be healthy, kids are spending an awful lot more time in front of the screens these days. And as we say with games have a huge entertainment of value payoff. You pay a small amount, you get hundreds of hours of entertainment out of it. It's also kind of it's really on this the kind of riding the crest of this wave of a kind of a new generation of games, which are a lot more about social network, and rather than kind of a single transaction, it's kind of a game as a service. You pay as you go, as you play, and as you add more stuff to it.
Yeah, I read a story somewhere about kids hosting birthday parties on Roblox over the last few months.
Yeah, you can rent out a server. You can do loads of stuff. I mean, Lil Nas, what's the song? Luke, you're the young one.
Old
here.
Town Road.
Old Town Road.
Come on, Rory. Boomer.
Old Town Road. He hosted
You played a gig there.
A gig there, and 33 million people attended it in this virtual space.
Well, your point there, Rory, about gamers become coders. Well, it was this kind of platform that gave birth to the second richest person in the world, none other than Mr. Elon Musk, who I think moved into second place very recently. And it was a very, very similar precursor to Roblox back in, I presume, late 80s or 90s, where Elon Musk started to learn his coding chops. And next thing you know, world dominance.
So we're getting a new generation of Elon Musks. Brilliant.
Yeah. So I think it's going. I think Roblox is due to go any day now. Something like an IPO valuation of $8 billion.
Wow. Any other companies you're looking at?
Well, I have a few. Let me hit you with a few. Bumble is a name that might be familiar to some of our listeners. It's I suppose it's a Tinder-esque dating app. But I think it's going to IPO in early 2021, something like $6 to $8 billion valuation. But it has reached more than 100 million users in 2020, which it monetizes via advertising as well as a premium subscription option, which sounds very like Tinder. So that is one that I think is quite interesting, but it's a very crowded space. Barriers to entry are quite low. I think they have a nice angle, the fact that the female is in charge, but it's definitely one to watch, and it's one of those giants sitting outside Match.com's wheelhouse. Yeah. Match.com, as our listeners know, also own Tinder amongst very many other ones. Another IPO that I'm quite intrigued in is one that sticks out like sore thumb because it's actually profitable, and it's called AppLovin. AppLovin. I know it's strange. AppLovin, bizarrely, is profitable since it was founded in 2012.
I don't trust it.
No,
Yeah,
exactly.
I don't like it
This
at
is
all.
true.
What's going on here?
Yeah, so what it has done, and this is quite interesting, following a Roblox conversation, it's built a platform to help game developers build, manage, and monetize their apps. And the company has created its own gaming studio called Line Studios, and it has 750 million daily active users and reaches more than 2 billion devices every month with its assets. So this is a big deal that you possibly have never heard of, AppLovin. So that's another one that I think is very interesting. They're kind of talking about early 2021 for it to go live with IPO. Another is Instacart, a company that have we discussed on the podcast before? I'm not sure, but 2010, the founder of Instacart left his job with the fulfillment center at Amazon. He moved to San Francisco and he decided he was starting a business, and as these things go, he found a lot of resistance and speed bumps and tried product after product after product. I think he went at it something like 24 times. He had 24 startups, but he eventually hit on something, which was an on-demand network for delivering products and groceries to your home. And at the heart of it was an app which is kind of connected to people who went off and did the shopping for you, which I think is an absolutely wonderful business, believe me. So the last round, Instacart, it's a big deal already. I mean, the last round of Instacart valued it at something like $18 billion. So there's no real estimation its IPO valuation, but one of my predictions, and we usually do this in January, but I do think Instacart will be I think it's going to be in the top 3 biggest IPOs of 2021. Wow. Will I go on? I have more, James. Will I keep going, or do you want me to shut up?
we better let Rory talk for a while. Rory, any IPOs you're looking at?
Thank you for letting me speak. No, I mean, Airbnb has to be mentioned, doesn't it? Like, that
absolutely
the big news. You know, as a consumer, I've been a fan of Airbnb for close to a decade now. I think, like, with Airbnb, before the pandemic, definitely, there was a couple of kind of like lingering concerns about the business as an investment, you know, and that kind of included whether this business was kind of good for the community as a whole. And I think, you know, having listened to multiple interviews with the founders and the executives, I absolutely believe the mission was to be a net positive for the community. And I think in terms of its success, you know, Airbnb did, above all else, in my view, one of its great successes was a kind of monetized trust. You know, anytime you go away from your home, particularly if you're in a country that's foreign to you, for example, your number one priority is safety, right? Even if you're not aware of it, that is your number one priority. And Airbnb created this feeling of safety by creating kind of a commitment device or a trust placebo, because the person whose house you were staying at kind of had this financial incentive to make your stay as pleasant as possible. And they did this through like the rating systems and the Superhost label and all that kind of stuff. But also in the background, there was this kind of idea of Airbnb acting as a neutral broker between parties, and that they had this incredible customer service to the point where, like, you kind of felt like if anything went bad, there would be no ends to Airbnb sorting out the situation. You know, whether if they needed to chopper you out of there on a helicopter to get you somewhere good to stay that night. You know, it seemed that was kind of the level that they were aiming for in terms of kind of customer delight. And then but then there was the negative of the model, which is that it wasn't being used for purposes as intended to. Landlords were buying up properties and promoting them on Airbnb. It wasn't really in the spirit of the company. It was causing problems with local councils, causing problems with housing. And there was a couple of cities that, you know, outright banned them or brought in tough legislations regarding it. So that was the kind of pre-pandemic worry, right? Now we're in a totally different environment where it's the post-pandemic worry, right? And that's...
Go on, Rory, say it. Say we're in unprecedented times.
No. Okay, we're in unprecedented times here, people. You have to listen to me now. No, I mean, like the big question now was, you know, what happens when, you know, the you know, all real estate, as we've talked about before, is a buy long, sell short kind of business, and Airbnb for a lot of landlords was the buy long, sell as short as possible business, which you know, unbeknownst to them, could potentially explode at any moment, and did in the early part of this year. And so big challenges with the company in terms of winning back the landlords, winning back the customers, being able to enable, you know, the massive worldwide network that they have in terms of getting, you know, people just weren't traveling, people didn't want to stay in other people's homes. And they pivoted really quickly and really well, I think, in terms of, you know, I think, Emmett, you said, your own front door is better than a hotel lobby in a global pandemic. And that's definitely the case, and people were still needed to vacation. They still needed to travel locally. So they did pivot. It was painful. They had to make big staff cuts. They had to, restructure the business. I'm sure that was a very painful experience for everyone involved. So it's looking like they're coming out the other side of it. There's still a couple of questions related to their S1 that I have in my mind. One of which was that, with this big cut they did in, first of all, why was their S&M budget so big? I always expected Airbnb would have this amazing organic sales funnel. Airbnb is the first place I go to anytime I'm traveling abroad. I go straight to the app. I never Google. It's straight to Airbnb, and in the rare case that I can't get something on Airbnb, I go off to one of the larger OTAs like Booking or Expedia. But those guys are spending huge money on things like Google. Like, their entire businesses rely on Google. So the fact that Airbnb was spending so much on sales and marketing pre-pandemic on a kind of similar level to the old OTAs made me kind of question what was going on there. And I suppose the big question is, are they going to be able to sustain growth with this new slashed sales and marketing budget in the face of the pandemic? That's the kind of $1 billion question with Airbnb. But overall, love the culture of the business, love the products, rooting for them, definitely rooting for them.
Absolutely. Any other companies in your watch list?
Do you know what? This is a weird one now because I have railed against food delivery businesses in the past, but I did take a look at DoorDash's S1, and I have to say I was incredibly impressed with it. The opening statement that the mission of the business is to grow and empower local economies was a good one, I thought. And the way they broke it down was that, they think of themselves as much more than a food delivery business. So the three things that they're aiming to do is to create an on-demand logistics platform that can facilitate local delivery of any item. They want to grow merchant services to grow sales in the modern era, and they want to develop a membership program to the physical world for consumers. So really what DoorDash, I feel, are trying to pitch themselves at, or their long-term vision, is not just food delivery. It's this kind of digital wallet that connects you to the local economy and makes a kind of hybrid between e-com and local commerce possible, backed by kind of incredible operational performance. And their S1 was just kind of really clear. They highlighted their weaknesses the way with the exact same tone that they highlighted their strengths. They've been very positively affected by the pandemic. Total orders went from 70 million in Q3 19 to 236 million in Q3 20. So that's a 3x jump there. And certain kind of problems I've previously had with food delivery businesses, they're not totally tackling, but they're trying to tackle them. For example, in terms of discounting, they start out at a high discount in order to acquire customers, and then they kind of re-engage with lower discounting as each cohort matures. So they're addressing kind of the bigger problems within that sub-industry. And it was one of the kind of ones that I didn't expect to be interested in, but I am interested in.
Yeah, and I think it's worth pointing out that they're far and away the biggest food delivery company in the US by market share.
They are killing it. I mean, not being in America, never really had the opportunity of engaging with them, but I would have thought Uber Eats would have been a much bigger competitor to them. No, they are owning that space.
Yeah, so there's a few companies that with their IPOs coming up in the next few months.
I have one more, James, just for, I suppose, close with something a little bit. Well, they don't think it's whimsical in there, but I think it is. It's Petco. And Petco is it looks like it's going to go public again. It's done it 3 times already. This is its fourth IPO.
Did you say an IPO is for life, not for Christmas?
Luke, cut that part out.
Ironically, they sell dogs. But so they are fairly familiar with it, so it should go well. I mean, I think they floated in.
They've had good practice.
So these guys have been in and out of bankruptcy 50 times, so they're going to be great at it.
Well, they had this kind of nagging issue, which is called bricks and mortar. And then Amazon came along and rained on their parade, and then Chewy's came along and rained on their parade. But what they've pivoted is Petco is a health and wellness co. So they forget about the 94 IPO and the year 2000 IPO and the year 2002 IPO. It looks like next year is the IPO. IPO number 4 for Petco in 2021. Put it on your watch list, folks. I mean, who could argue with that?
Were they the company that was backed by Whoopi Goldberg back around 2000?
No, that was
I think pets.com. Yeah, that's right.
sorry.
But no, hold on a minute. Whoopi Goldberg backed Flooz, Flooz. But I don't
did they
think she
do?
was involved. It was a kind of an online currency, which nowadays we just call currency, but we call money. Flooz, I think, and I really stand to be corrected here, was a way for you to swap your dollars for an online internet currency that could be used on internet websites.
Yeah.
And
Was the unit of currency called a flooz? Like,
Yeah.
I
you
think
had two
so. Yeah,
floozes.
yeah, it was.
It was basically shut down by the FBI because it was being used almost exclusively by Russian gangsters.
So who would play Whoopi Goldberg in a movie about Flooz?
Whoopi Goldberg, I imagine.
She'd have to do it. She'd have to take the role. I mean, nobody.
Was there
Anyway,
a celebrity involved with Pets.com then? There was there? I thought she was with Pets.com as well.
maybe you're right. I don't remember, Roy. But
She was
yeah,
like the
I mean,
Ashton Kutcher of the tech bubble, wasn't she?
Yeah, exactly. She was the Ashton Kutcher of the tech bubble.
Answers on a postcard to MyWallSt, please.
Yeah.
So let's move on from the IPOs and take a quick look at some of the other things going on in MyWallSt at the moment. We've already spent the first half of this show talking about IPOs, but if that wasn't enough for you, then you need to check out the free webinar that Emmett is hosting next Tuesday, December 1st. In this Master Investing workshop, Emmett is going to go through the process he uses for tracking and choosing the IPOs and SPACs that he invests his own money in. Attendance for this workshop is capped and spaces are already filling up fast, so if you want to attend, make sure to register at the link in the notes for today's show. Emmett, what can people expect if they tune into this webinar?
Well, yeah, James. So as you said, I plan to cover on how I research IPOs and SPACs and the critical websites that anyone who wants to do the same should use. And I absolutely intend for this to be the most practical and impactful and information full webcast that I've ever done. I want attendees to walk away just pretty invigorated about their own ability to look at IPOs and SPACs and what they should look for and how to find a good one and how to kind of leave behind one that doesn't look so promising.
Cool. So make sure to sign up for that. If you're looking for some more stuff to listen to too after today's podcast, we also have a new guest series with our friends over at Noah going live today called Why the Gig Economy May Have Been Changed Forever. Remember, Noah, spelled N-O-A, offers professionally read versions of articles from the Financial Times, Bloomberg, The Economist, Harvard Business Review, and a load more of top publishers. They've also recently added articles from Fast Company to their service, meaning that there's even more great business content available for you to listen to. You can find that series in the Noah app right now. Right, let's move on to Jargon Busters. And Emma, I'm going to come to you first. This question is one we actually get quite a lot here at MyWallSt, and it comes back to the idea of diversification and the kind of advice we give that you should build your portfolio across a wide spread of companies. But is there a right number of stocks that an investor should aim to hold?
There's no wrong answer once you, I would say, have at the very, very, very least 10 stocks. What would you say, Rory? What do you think is the most concentrated portfolio should be?
Yeah, I mean, I suppose this question gets asked so often. I guess the way it gets kind of phrased most of the time is, how do I start if I need to get to this number of stocks? You know, do I need? I got a friend investing recently, and he was so flummoxed by the whole idea. He was like, "But you say I have to have 10 stocks, and I don't have enough money to buy 10 stocks." Now it's like, look at this. Okay, separate the point in your life where you're building a portfolio to the point where you have a portfolio and you're managing one. So when you're building a portfolio, build it over time. Don't worry about how many stocks should I have right now. You know, you're learning as you're going. You're buying into companies that you like, and you're discovering new companies all the time. So don't worry about that. Aim to get to the 10 stock point. You know, maybe take 12 months or take 18 months to get there and buy a stock a month until you get to that point that you're happy with. Once you've gotten past that point, then you can start thinking about managing the portfolio over a long period of time. And the right number of stocks is so personal. You know, someone a few years ago tried to figure out how many kids someone should have. You know, and I think he came out with 2.1 based on kind of research of how much time can you spend with them and what's meaningful time versus what's just, you know, putting in the hours. And but obviously that 2.1 doesn't account for everyone. It's some people are going to want to have 6 kids. Some people are going to want to have no kids, you know. So it comes, the right number of stocks for you is the amount that you feel comfortable holding and being able to keep an eye on and being able to research, not all the time, but, you know, every couple of months you should be keeping an eye on your portfolio, making sure there's been no major developments. You know, you want to just be on top of things. And for most people, that means, less than 100, definitely, probably less than 50, probably less than 20. If you're if you're in between 10 and 20, you're probably in a good spot.
I think I remember you saying once, Rory, that, and maybe this wasn't in reference to how many stocks you should have, but maybe stocks that you own that are, maybe at or near all-time highs. And you said that if you're losing sleep over it, that's the best sign to sell it. And it comes back to the idea that, your portfolio is an intensely personal thing, and it's your comfortability and how it fits into your life and your long-term plan is probably one of the most important things to consider.
Yeah, and there's so many variables. Like if you had 30 stocks all spread evenly, what's going to happen there is you end up getting a 20 bagger. It's going to have very little impact on your portfolio. So you don't want that. You probably only hit, a couple of big winners in your life, even with great advice that we provide here at MyWallSt for a reasonable monthly subscription. So you don't want to
read the promo code.
So you don't want to. You don't want to limit your upside when it comes to dividing, your wealth among stocks. But of course, you could end up having, 10 big positions, and then you could have 15 kind of small little, put a bit of money into something, see how it goes. And that's different from having, 10 big positions evenly spread. So it all kind of depends on your own personal kind of style and how you want to spread your money around. But 10 and 20 is a broad range for most people, I think.
Absolutely.
And your stock portfolio is, if you look at somebody who's been investing for several years and has gotten into the swing of it and has built up between 20 and 50 stocks, for example, that list of stocks is it's an autobiography. It tells the story of that person's beliefs and interests and even risk profile. If somebody's built this portfolio based on their own belief set, you can look at somebody's portfolio and tell the kind of person that they are and the beliefs that they have about the future and their kind of propensity for risk. But Peter Lynch in One Up on Wall Street, I think he mentions that at one stage he was holding, or the Fidelity fund that he was managing was holding 2,000 stocks, which I think was the highest number I'd heard of. And I have met some very successful investors who will not go above 12. So you can have hyper-concentrated folio of 12 or so positions, or you can become a legendary investor, as did Peter Lynch, with thousands of listed companies. But as Rory rightfully said, I think the right number for a person is very personal, as long as you decide you're going for a minimum of something like 10 or 12 or 15 stocks. And Festina Lente, hasten slowly, build out your portfolio, in build mode for a couple of years and then maintenance mode for the rest of your investing life.
Absolutely. Rory, the next question I'm going to throw over to you, and we've spoken about the humanization of pets a lot on this podcast, including that dreaded term fur babies. And we currently have stocks like IDEX and Trupanion in the MyWallSt shortlist, but are there any other pet stocks on your radar, and not pets.com maybe?
Well, Emma, you mentioned one the other day, which was instantly interesting, Freshpet.
Big fan.
They make like, there used to be this guy, right? I can't remember what the name of the company. It was Blue Buffalo, I think was what it was called. Mm-hmm. And they made like pet food that was so good that it was like fit for humans. And the CEO used to go on Jim Cramer's Mad Money pretty much on a monthly basis and open a can and eat it live on television. So that's what I was reminded of when you told me about Freshpet. They do like healthy food for dogs and cats and
maybe humans.
And humans, if you're really stuck. If you find yourself 2 a.m, no kebab shops open.
Completely. I know, I'm with you though. And the only reason that I personally haven't invested in Freshpet or pitched it for Horizon is that the bane of 2020 was everything has done so well. I mean, it's been on a run. Right now, Freshpet is a $5.3 billion business. They drop fridges into convenience and supermarket and grocery stores, and they fill it with their product. And certainly to position it, as Roy described, that it is appealing to human senses. And of course, dogs aren't notorious for complaining, they'll eat, from what I can see, virtually anything. So, I'm sure the loving owner looks down at their dog, feels good that they're eating organic, fresh, wet food, and everybody wins. But yeah, it's a lovely business, Freshpet, and I can see it going from strength to strength.
I think it's probably worth pointing out as well that, to kind of invest in the humanization of pets trend, as you say, doesn't just apply to, things you actually give your pets or things used to treat your pets. Companies like Lemonade, for example, offer pet insurance, I believe.
Yeah, they've just got into the pet insurance space, and as we talked about when we added Trupanion a couple of years ago, that was one of the most underserved markets that I've seen in an awful long time. The percentage of pets that were being insured in America was around the 1 to 2% mark, whereas in more developed markets like Canada and in Scandinavia, that number was up around 25%.
Wow.
So that was a huge opportunity for Trupanion. And that stock kind of just, when it went sideways for a couple of years and in the last couple of months, has really shown to be a winner. And Lemonade's getting into that space now as well. Another company that I have just had a brief look at was Chewy. I know Jason Moser is a big fan as a customer anyway. I've never actually asked him about it regarding as a stock. But the one thing that kind of threw me with Chewy, first of all, there was the obvious pets.com comparison, which we talked about earlier. It's a kind of similar business model, though. The big problem with delivering pet food is it's got a very low value for weight ratio. You know, pet food is heavy. And it doesn't cost a lot, so people don't like shipping, and it doesn't make economic sense. The other worry I have with Chewy is that Walmart has gone very heavy into this space. Walmart has really gone after the pet space big time in the last couple of months, and they've launched a couple of new products, including kind of everything from dog walking to pet insurance to pet health care to subscription models for pet food, and that's a big problem that Chewy is going to have to face. But I wouldn't make a call on it just yet. I've kind of only read on the outskirts of it, but it's another interesting one, and people who use it, definitely customers, seem to love it, so that's always a kind of positive sign for a company.
Cool. Let's move on then to our elevator pitch to finish off the show. Over the past few episodes, I've asked you guys to pitch your favourite razor and blade model company, your favourite pick and shovel model company. Today we're going to go a bit more poetic and ask for your favourite land and expand company. So just to clarify, land and expand companies are ones that initially capture a new customer with a relatively small and sometimes even free product or offer, and then manage to expand their footprint gradually within the company, selling add-ons and other services to get more money out of each customer. Emmett, I'll come to you first. What's your favourite land and expand company?
Oh, when I hear land and expand, I think of one company first, which is Trello. Atlassian, makers of Trello. And Atlassian is a business I admire so much. Sydney, Australia-based B2B software maker. And why I like Atlassian so much is that it really only takes one person in an organization to convert everyone inside that business over to the tool, which usually starts with, to the product set, usually starts with one tool. For example, Trello is a let's slip at the start piece, and Trello is a kind of work management tool where you keep a tag on everything you need to do and assign it to other people. And generally what you'll find is there's somebody who won't deal with you unless you use this tool that they've got. So you're recruited into using it. You're forced. Your hand is forced. I don't know. We've seen an awful lot of these kind of things around MyWallSt.
Let's not name any names.
I'll name names if you want.
Are you thinking Alesh?
Yeah. Sorry, Alesh.
Our Chief Product Officer. Yeah, exactly. So you should really be doing this segment. But anyway, so Trello, you start with Trello, and next thing there's a whole team using it, and then there's complementary tools. And Atlassian has a suite of tools: Trello, Jira, Confluence, Bitbucket, and many others. So it is by far my favorite land and expand, and especially when you look at the numbers behind its land and expand model, where I think 70% of businesses are completely infested by by the products as soon as they start. So yeah.
Seeing as we've already started naming names, is it JT, our co-founder here? Did I hear a rumour he runs his household or his kitchen at least on a Trello board?
Of course he does. John's the most organised guy I know. There's a Trello board called Fridge, I'm pretty sure, in John's arsenal, where he can basically keep inventory on everything inside the fridge.
To be confirmed. We'll get back to you in the next episode about that. Rory, your favourite land and expand model?
Yeah, well, Atlassian is the original land and expand, isn't it? That's the first time I ever saw that model in action, Emma, was when you and me looked at Atlassian all those years ago, and it was just like, that's just an incredible... It was so amazing because it kept... sales and marketing so down. They inverted the whole system. They were spending like 40% of their revenue on R&D and practically nothing on sales and marketing. So since then, it seems to be everywhere. There's so many businesses we've looked at it that they've copied the model. Twilio is obviously a really big one. Slack, all these, we see it so much in our own business that programs that we'd never heard of before the tech team started using, and now we all have to use them because that's the way the tech team wants things done. But the one that
was the fax machine land and expand?
Well, this is the one I'm going to pitch now, which is that the killer of the fax machine, DocuSign, is one of my favorite land and expand businesses. Again, I think it was John Smith from the business who started bringing in DocuSign, and now we use it for kind of all our contract signings. It's so easy, it's so handy, and the company took a big hit when the vaccine news came out, as if people were going to stop using DocuSign when a vaccine emerged. I think it's going to be a great long-term winner. I'm a shareholder myself, so that's my pick for land and expand.
Somehow that elevator pitch segment turned into a bit of a grudge match, airing out our grievances around my Wall Street.
Who else in the business has annoyed us in the last while?
That sounds like a new segment for the podcast. So let's leave it there. That's it for this week's Stock Club. Don't forget about all the great new stuff in MyWallSt at the moment. And if there's anything you want us to discuss or explain on the next episode, make sure to get in touch. You can find us on Twitter, as always, at MyWallStHQ, or email us at pod@mywallstreet.com. That's pod@mywallstreet.com. Don't forget about Emmett's webinar next week too. The note to sign up there is in the notes for today's show. Please leave us a review as well if you liked today's episode, and we'll talk to you in 2 weeks. Happy investing. This episode of Stock Club is brought to you by Hyundai. Restart your journey towards a greener world with Hyundai's next generation of zero-emission cars. Find out more about their range of electric vehicles and the savings they can bring to your company and employees at Hyundai.ie.